All right, welcome. Today I'm going to show you how you can finally scale your agency past $20,000 per month. Quickly, we are Sustainable Profits and we help purpose-driven entrepreneurs accelerate their financial goals by paying less tax. We can also help you implement all of these processes. So reach out if you find any value in this video. So the problem and the reason why you can't scale your business past $20,000 per month, it's not your fault. This stuff isn't taught in schools. I actually only discovered this problem while I was working with my clients. So I'm a chartered accountant, which means that business owners trust me for business strategy, for tax compliance, and for helping them on their wealth building journey. I saw time and time again that businesses struggle to make it past a certain bottleneck. When the ultimate goal is to own a highly profitable and sustainable business, that's a beautiful machine that just spits out surplus cash that you can use to fund your lifestyle, invest in assets, and free up more time. Lots of people tend to get fixated on the highly profitable part and forget about the sustainable part. And I wanted to explain that a bit further by telling you a story of one of my clients that I have and their story before we started working together. So this client is a digital marketing agency. And they had a false start last year. So they specialize in doing marketing agency services for not-for-profits. And this client, he was just cruising along. It was a one-man band doing $10,000 per month. But he did have some bigger goals and he wanted to scale so he could take on bigger projects and hire great employees. So he upped his sales and marketing efforts. And it worked. He ended up having a record month of $20,000, $387, which was nearly double his previous month of $11,971. And I just wanted to quickly look at this graph below. So the graph below is revenue per month. Just take a look what happened after he hit his record month. You can see here in June, massive $20,000 month, and then the next 2 months, $6,000 each. He burned out. He let go of his employees, he fell out of love with the work, and he didn't renew projects with new clients. And so he approached me after this, and now we're working together to build the business of his dreams. One that allows him to travel the world. He's going to the UK soon with his partner, and will still continue to serve his inspiring clients. But what am I actually helping with? The first thing that we do is we're going to get the foundations right. You need to get the foundations of your business right before you can scale. So I wanted to do this quick imaginary task with me. Imagine you want to build a tower and your only job is to build it as high as possible. And you can choose between 2 different materials, shoe boxes or a deck of cards. Look, I know some people can build some pretty impressive card towers, but every day of the week, I'm going to be choosing shoe boxes to build my tower because they're strong, they're stable, and they're easy to use. And unlike a house of cards, that would topple with any old gust of wind. And business is the same. You also need to get the foundations right before you can go big. And there's 2 key drivers to any online business that are foundational things you need to get right. The first is client acquisition. So how you actually get clients. And this is things like advertising, marketing, content creation. In the new day and age, organic content is massive. And the second thing is fulfillment. So how you actually deliver your product or service. So labor, paying people, operations, and software. And your ability to make a profit from your business wholly depends on how efficiently your business does client acquisition and fulfillment. I'm sure you've been the same here. So most agencies actually start as a sales machine. You set up the cold email campaigns, you're in the DMs on Twitter and LinkedIn, you're watching Alex Hormozi on how to close. But the truth is that once you reach $20,000 per month, you need to become an operations machine. I get it. Client acquisition is the number one pain when you're starting from zero. I've been there. But once you have a roster of clients, you've already got the income and you need to know exactly how much it costs you to deliver your service. So I want to present to you the foundational rule for your digital agency. The 50-10-10 rule. And it goes like this. 50% of your revenue needs to go towards fulfillment costs, 10% of your revenue towards client acquisition costs, and then 10% of your revenue goes towards all other expenses. That's it. That's all you need to know and remember. This is the foundation to get your business to 7 figures. This means a healthy 30% profit margin before tax, and a well-managed business that sticks to this framework is unshakable. That is my promise. There's a few tricks and traps that you can fall into here. First of all, if you've ever heard of Profit First, how they do their financial management is you set up like 27 different bank accounts, and then you put cash into each one and only pull from that bank account if you're allowed to. And if it's empty, too bad, your business is going to suffer. I don't like that. That's too boxy. And so this 50-10-10 rule is not technically a rule. It's okay if you break it. It's more of a framework and a guideline. You can't force your numbers to fit into this box, but you should be comparing your rules. You should be comparing your numbers to the rule. So if your fulfillment costs just happen to be greater than 50%, it's okay. Don't immediately reduce your headcount or lower salaries. There might be some other reasons why you choose to live outside of the rule. If your business prides itself on delivering world-class service, maybe you need to accept lower profit margins so that you can pay top dollar for the world's best employees. Paying bonuses, paying above market rates, it might just be your choice to do that as a part of your business model. And the second thing that you need to consider, another trick, is owner's pay. So it's critical to factor in your pay as the owner and what your economic value is in your labor costs. Even if you don't physically pay yourself, like even if your accountant doesn't actually pay you and you withdraw cash, that's fine, but you still need to account for your economic value. You have no idea how misleading your numbers are if you're not factoring in your own pay. Your labor costs will be ridiculously skewed. So think about all the functions that you do inside of your business: sales, marketing, fulfillment, IT, finance, I know a guy, customer service, human resources, and the list goes on. You need to make sure that you're appropriately accounting for all the services and functions that you do inside of your business to accurately assess how profitable the business is. So, because you're into business, chances are you're probably also into self-development and fitness. And if you've ever Googled intro to bodybuilding, I'm sure you've learned about bulking and cutting. If you don't know, a bulking cycle is when you intentionally eat more food so you can lift heavier weights at the gym with the goal of eventually building muscle mass. But when you're eating more food, gaining some fat is inevitable. You're going to get a little bit soft. But if you want to then get your body summer ready, you need to trim the fat. So you're then going to reduce how much you eat and modify your workouts. And if you do this correctly, you'll keep the majority of the muscle that you put on in your bulk, but you'll start shredding off the excess fat. And after this full cycle, you're back to the same body fat percentage that you started with, maybe even lower, but you have bigger muscles. So this cycle is tried and tested and practiced by bodybuilders all over the world. So you start as a skinny fella, then as you bulk, you get to a heavy fella, and then as you cut again, you're left back as a skinny fella, but maybe with bigger muscles. And that's the plan. That's the cycle tried and tested. Well, it's exactly the same as online business. When you're bulking, you're scaling revenue, and when you're cutting, you're maximizing profits. They're the two seasons: scaling revenue, maximizing profits. At any given moment, you can only focus on one of the seasons. You can't do both at the same time. You can't bulk and cut. You can't scale revenue and maximize profits. And it's because each season requires a completely different focus. Scaling revenue means that you have to invest resources into marketing and hiring new staff, whereas maximizing profit requires increasing efficiency of the resources you already have. So your only focus is to break the rule, the 50-10-10 rule. So I know I said earlier that if you stick to the rule, you'll be unshakable, but I want to encourage you to break the rule. In fact, if you want to scale, you have to break the rule. If you're focused on scaling revenue, you need to focus on getting clients in the door. You will be investing resources into paid ad campaigns, testing new methods of creating content, growing your sales team, monitoring client fulfillment. You'll probably then have to hire some new staff in order to fulfill the new demand. And then once you've grown the revenues, you need to trim the fat. Your business might have broken the 50-10-10 rule and might be running now at a 15% profit margin rather than 30%. So this is when you transition into your cut, into the second stage of the cycle, which is maximizing profit. You need to give your new staff time to get up to maximum efficiency. You'll spend time investing in increasing operational efficiency through automations, training staff, and creating SOPs. This is where you see massive productivity increases, but you'll keep the same level of revenue. So in this stage, you'll eventually make your way back to the 30% profit margins, but at your new level of revenue. So let's quickly just double down into this. Let's say you start at let's for this example, you're $20,000 per month and you're at 30% profit margin, which is $6,000 profit. And you go into a bulk season, into a scaling revenue season, and you're planning on getting to $40,000 per month revenue. If you hit $40,000 per month revenue, you're not expected to keep 30% profit margins immediately. You might get to $40,000 revenue, but only make $10,000 profit, which is a 25% profit. Or you might even keep the same profit of $6,000, which will then be a 15% profit margin. But that's because you've been spending all this money on ads and hiring new staff and all of these things, just testing all these growth initiatives to see what works, sacrificing some profits in the short term. But eventually, once you hit your $40,000 per month, we need to stabilize. We need to get back to 30% profit margins. So what's that? $18,000. We need to then be getting 18. Is that right? 12. We need to get to $12,000 profit. So think of it like driving a car. So if you're just coasting, you can coast pretty easily at 60 kilometers an hour. If you want to be going 100 kilometers an hour, you need to accelerate. You need to put your foot down on the gas pedal, causing the engine to work harder. The car's going to be expending more energy to accelerate than what it was when you were just coasting, but once you get up to 100, you can just coast again. And the engine doesn't have to expend as much energy to maintain this speed. So when you're just coasting is when you're maximizing profits. This is your most efficient times, and then you need to sacrifice profits in the short term to get to that next level. And then you can coast again once you're at the level. So I just want to quickly wrap up with 3 simple steps that you can do to break through the growth barriers. So the first step is to benchmark yourself against the 50-10-10 rule. Most people we speak to are stuck because they don't have the measuring tool to see how their business is doing. So most of the time their books aren't properly configured for their specific type of online business. Most traditional accountants aren't very good at online business because they've been taught with business models like manufacturing or like cafes. They don't understand online service delivery. So this step will often involve renovating your accounting system so you have the measuring tool that you need to benchmark yourself against the 50-10-10 rule. And you can do this by rearranging your chart of accounts so that all expenses fall into the correct subcategories. But do remember that you need to include owner's pay in the analysis. So how much would it actually cost to replace you? The second step is to identify which season you're in. So remember, you can either be scaling revenue or maximizing profits. So if you've benchmarked yourself and you're already in line with the 50-10-10 rule, then maybe you can consider entering a scale season. Make sure you have enough cash on hand though to ride out the waves and give yourself enough time to reach capacity. And if you've benchmarked yourself and you're failing the 50-10-10 rule, then maybe you should consider investing into efficiency. So the easiest thing to do here is to increase your prices. Most young businesses that I work with price themselves too low and are shooting themselves in the foot when it comes to profits just by pricing too low. Quick win there. Step 3, focus 100% on that season for at least 3 months. Just commit to that season. Write out a list of 5 to 10 projects that fit the season that you want to enter. So if you want to go into a scaling season, here's a couple of examples of what you can do. You can double your Facebook ad budget, start a pay-per-click ads on Google, hire a YouTube ads agency, improve customer retention by maybe hiring a customer service manager, customer success manager. Maybe you can find a video editor to increase your content output and you can get more organic traffic. And a couple of examples for maximizing profit season. Maybe you can try some new softwares that will help with automation, delegate some low profit tasks, hire a virtual assistant, create SOPs and systems, and train your staff. And once you have this list, prioritize them 1 through 10 and set aside a couple of hours a day to work on your list, starting at number 1 until you tick it off. And make sure you give yourself at least 3 months to work through the season. That's how long it takes to actually see any meaningful results. That's what we found with our clients. If they don't give themselves at least 3 months to have a crack at a season, then it's not going to stick, it's not going to be sustainable. And so if you want a copy of this document, just leave a comment in the comment section below. And if you need help implementing this is our company, Sustainable Profits. We can help you build a customized strategic financial roadmap that gives you the holistic picture of your business. We can help you decide which business season you're in, and we'll hold your hand through the process. And we can also keep you accountable to your financial metrics and give you the tools to make better decisions, as well as helping you pay less tax. We're also online tax specialists. So that's it for this presentation. But if you do want this document, leave a comment in the comment section below.